Okay, so once again, welcome everybody. Glad you're in here, and thankfully this is recorded for a lot of people that are not going to make it because of the holiday weekend. I'm sure a lot of people are at cookouts and various fun things. So they don't want to waste time watching this. But anyway, today we'd like to talk about what to trade and when to trade. I've got a couple of extra things too. Pips, margin, money management. This is relatively beginner stuff for a lot of people. Okay, but there's nothing wrong with going over it a second time, even if you've heard all things like this before. It's probably not going to hurt you to hear it again. Okay, just a refresher. A refresher course. Okay. So everybody says, this market moves 24 hours a day, and you can just jump in anytime you want to, and that's what's sold, right? They sell that on every advertisement that you ever see for Forex on TV or radio or anything else, right? And they're basically telling you that liquidity is incredible all the time. You can do anything you want, trade when you want, and this is very appealing. Okay, to the people that work a job, and especially in the USA, if they're working a job and they don't get home until 5 o'clock at night, 6 o'clock at night or something, they're thinking, oh yeah, I can get in there and I can trade Asia. They're all excited, right? But it's not exactly so, okay? Because the whole thing is you need to stock a trade, and if people don't understand what's happening in the Asia session, that there's an Asia market maker range in it, and it's usually only around 30 pips or so in any direction on any pair, they may get very confused about the market and sit there and wonder, like, why is it not moving, and why is it going up, and then it looks like it's going to break out and it turns around and falls right back down again. A lot of people don't know about that. It takes them years to figure that out, that there really is not a good time in Asia to trade. Okay. So, but anyway, regardless of Asia, okay, patience and stocking a trade is a very, very important thing. How many times have you ever gotten into a trade, right, just to watch it go against you by 10, 20, 30 pips, something like that, and you were thinking about putting a second bullet on, or maybe you were thinking about stopping out, right, and then just to see the trade go right back up to your entry, maybe a little bit higher, maybe 10 pips higher than your entry, and dive. Or you booked it and then it dived. It dove right back down again. Okay, so this is irritating, all right? If you don't get the right entry, or if you're not sitting there watching to improve your entry and to add to your position, very often you can see something just move a little bit. It'll wiggle and jiggle, especially like the example before, the Asia session. You might be looking at 20, 30, 35 pips of movement, and you're in profit and out of profit and in profit and out of profit, and you're not really making anything. So, stalking a trade is a very paramount thing, and it often pays well just to wait and watch a little bit longer. Like when you get the idea and you say, well, I want to take this long, or I want to take this short, don't get too excited. Don't jump too quickly, okay? Because if you get too excited and you jump too quick, you may not be able to to get a better entry. And sometimes if you just wait 5 or 10 minutes and stalk it, you can get a lot better of an entry. Because think about it, it's swing low to swing high. It's a maximum move. If there was a maximum move of 50 pips, you may not be able to get all 50 of those pips. But if you can get 30 of them, then that's a good thing, right? So it's really paramount that we stock it and we get in as close to perfection as we possibly can. If we can't get in close to perfection, we want to find a way to improve our price, all right? And that will often be letting go of bullet number 1 with some stupid gain, like 3 pips or 5. But bullet number 2 that you put in, that thing might go out for 25, you see? You have to stalk it like a lion, all right? So anyway, not everything is right to trade all the time. That's pretty important too. You have to consider what's open and what is most likely to move at the time of your trading. For instance, during the U.S. session, all right, it's got certain pairs that are moving. Asia session has certain pairs that are moving. Okay, So high liquidity and news is a very good time to trade. You might have heard a lot of people say, "Oh, I don't like news. I don't want to trade at news time." A lot of people will say, "Sit this out." Non-farms payroll, don't trade it, just sit it out. And I think of that as absolute insanity. I mean, you want to trade when the time is going to be volatility and things are going to be rocking. There's going to be a lot of liquidity. There's going to be a lot of traders in that help to provide that liquidity, especially the bank traders and the market makers. Okay, so the very best time to trade is when there is going to be news. Red tagged news is awesome. Okay, beige tagged news is awesome. I don't like the yellow or the white tagged news because it'll barely blip. I mean, the market doesn't even look at that. Most of the time, they don't even consider that kind of news. But a news that shocks is a good thing. All right. So basically, for most traders, you want to be where the liquidity is high, and the London Open is another great thing when London does their famous stop run. Okay, pre-New York Open for pullbacks that occur right before the New York traders wake up is a good way. Okay, most New York traders are waking up around 7 o'clock, 8 o'clock, and they're going to be fully engaged in their game by 8:30 or 9:15 news time. They're going to be very engaged. Have you ever noticed that when you wake up at 7 or 8 o'clock in the morning and you turn on, you flick on your charts, you will see that there was a tremendous stop run that happened around 2 o'clock in the morning while you were sleeping. Okay, maybe it even hit you, I don't know. And then things went into an amazing trend for hours and hours on end, 4 hours, 5 hours, something like that. But they will always pull off the low or pull off the high of whatever's been made. And they'll do that right around 5 o'clock in the morning New York time to maybe 6 o'clock in the morning New York time. They'll pull back in, and the purpose of that is to trap other traders, okay, and leave them hanging where they can't get out, they can't show a profit. So anyway, these are all good times to trade. All right, it's the 2 o'clock a.m. in the London stop run, and very early New York. Okay, that's also another excellent one. Right now, the doldrums is not a great time. All right, doldrums is when the market goes to sleep, and it's after 12 o'clock New York. It's Eastern Standard, and it runs till about 2 o'clock New York time. It's a terrible time. Okay, the big boys are having their liquid lunches that will last for 2 hours, and it's just horrendous. Okay, it's a sleepy time. There's usually not a lot of movement. And you'll also have a very large doldrum period, which is around 4:30 or 5 o'clock on New York, and it will stay that way until about 7 or 8 o'clock when the Asia opens up. Do not trade then. Nothing is real then. Nothing at all. I mean, the markets are closed down. There's no liquidity at all. There's just nothing. I mean, Wellington Open is ridiculous. You want none of that. Okay, you want Tokyo to be open and the markets in Asia to legitimately be open before you attempt to trade. Okay, so you do have a few hours there. It can be good in the winter months, but it's usually not so great in the summer doldrums. And the best pairs to trade for Asia, by the way, are the yen crosses, the Japan crosses, especially odd in New Zealand pairs because that is what's open at that time. Canada's asleep, US is asleep, so it's not as good. Right? The best time, it's not the best time to trade US CAD or US Swissy. It's just common sense. Okay, I keep seeing one trader coming in and going out constantly. I'm wondering what's going on here. Maybe a bad connection. Okay, everybody live? Everybody okay? Sound is good? Anything wrong? I don't know if some people might be having a sound issue. I can't tell. All right, so it's normally just common sense, right? And we know about the market maker spread, that's a collection time. It's just sideways action up and down where they are taking the other side of a grand macro theme. All right, so if you saw, let's say you saw the euro up 6 or 7 days in a row, okay, 6 or 7 days in a row, stochastics are peaked, and the euro performs a stop run in the middle of the day. Maybe there was news at 10 o'clock or 10:30, and the euro shot up 50 pips and stopped everybody out, and then dives 150 pips and closes at the low of the day, making a daily sell bar, right? What do you think is actually going to be happening in the Asia session when it's whipping up and down 20 or 30 pips? It's an accumulation phase, yes, but the chances are going to be very big that the accumulation is to drop it, okay? It's just a pause and drop, all right? And so they're trying to get some more buy orders. Maybe they might even try and make it a little breakout, a little fake breakout, trying to trigger stupid people to get long so that they can sell to them, so that the very next day they can dive it back down. So you really have to look at the daily charts and the 4-hour charts and the 1-hour charts to determine, you know, that's like the general on top of the hill. He doesn't go down into the battle. He stays on top of the hill, and he looks down, and he sends his troops down to do the dirty work, okay? So if you're looking at 15-minute, 1 hour, and above, that's like you being the general, okay? And then you're looking into the smaller time frames. Let's say the 5-minute, the 15-minute could be chopping sideways for a long time in the Asia session, right? That is just to accumulate so they can tank it the next day, all right? By the way, this is a horrible time. You notice I capitalized that word? Okay, horrible to trade any dollar cross exotics like the US dollar TRY, US dollar NOK, anything like that. The spreads are going to kill you. Don't even touch it. It's closed. The session is closed. You'll see those spreads that are normally, 20, 30 pips or something like that. You'll see them jump to 150 pip spreads. So do not touch. Okay. Now, there's an infamous London stop run when New York is sleeping. All right, London open about 4 hours. Anything on that side of the pond is going to move. The pound is going to move. The euro crosses will move very well. This is a great time to trade like euro against just about anything, or the pound against just about anything. Stops are usually triggered somewhere around midnight, going all the way into about 2 o'clock in the morning New York time, when the market makers run and then reverse. It's a very common thing. They will often put a 6 to 8 hour trend in place after the form of that stop run. And so you have to consider your intraday swings after you see things like that. All right. So if you are a London trader or somebody on that side of the pond, and you see the pound shoot up and make a stop run and then start diving like mad, and I mean they pull away very fast. It's usually fast and furious. It could be a 1 hour bar that would be maybe 60, 70 pips wide. All right, and you have to think about why they're doing that, and they'll close that 1 hour bar directly at the bottom, and then when they open the next hour bar, straight down it goes. Think about why they're doing that with such speed and furiosity. Is that a word? Furiosity? Ferociousness? I don't know what the word is I'm looking for. They're trying to do that to scare the crap out of you so that you don't even want to get involved in the trade, because you're calculating in your mind and you're saying, oh my God, where do I put my stop? It's up at the top of that big pin bar with the long wick. Oh, I don't want to stop at 75 pips, and you don't even want to get involved, okay? So that's why they're pulling it away so fast. And they're trying to make it run in one direction so quickly very often. I know I'm kind of jumping out of our, what's up here. But I'm taking the thoughts that are coming to my head right now. I don't want to miss them, okay? You're sitting there thinking, I'll wait for a pullback, and that pullback never comes. You see, you're like, I will short the next pullback, and it doesn't happen, all right? That's on purpose. All right, so that you can't even get in. And soon enough, it'll be 100 pips away, and you're just going to be like, oh, I give up. I'm not even going to get in there. And they'll just keep on rocking it down, and you'll be sad. That's another common thing. All right. So anyway, this is all pretty simple. The trade what moves when it is the best and the most opportune time to do so. Now, again, some traders don't want to trade news, and I can understand that. Before news is being released, that makes really good sense, okay? But after the news, especially if it deviates from expectations, this is a great time to trade, as the news shocks can move the markets. And we want to trade when it's a good time to trade, not when something is flatlining. Do you really want to trade like today? Think about it. Just look back at your charts for the last 8 hours today. Was that any fun? No. Zero. Nothing moved. Was the patient even alive? Oh my gosh, this market holiday, it was dead zone, all right? I mean, we're talking comatose, all right? So you don't like that. I don't like that. Nobody likes it. All right, so now let's talk about some other things, okay? Pips. We've covered this in another video. It does vary, as you know, from currency pair to currency pair. Some pairs pay very low money per pip and higher money for other pairs. Like the Euro Pound is 50% more expensive, and Great British Pound Japan is about 12 or 13% more expensive as compared with the Euro. Things like the Pound Odd or Pound New Zealand are about 10 or 12% less. It's less money. So anyway, for our purposes, if we are firing micros all day long, and let's say that we end the day with $25. All right, we have our $1,000 starting account, and the day is over, and our scorekeeper says $25. We're going to say that we have booked 250 pips, because it's every bullet that's fired. It's every bullet added together. Now, one bullet might only make 3.5 pips. Another one might make 7. Another pair somewhere else might make 22, and another one somewhere else might make 15. You just have to add them all up, and if you got $25, you have 25 pips. Now, if our trade size was 0.10, and we were shooting all day with a 0.10, bigger bullet, right? Big hollow point bullet, right? And you end the day with $344, then you're going to say that you booked 344 pips. Now, I know that's not accurate. I've used the MyFX book, but the way it calculates pips on gold, oil, silver, TRY, other pairs, it just gets crazy. I mean, if you traded DAX all day, etc., I mean, you could brag at the end of the day and say, I have made 12,000 pips today. And you'd actually be speaking the truth, 12,000 pips, but it wouldn't be that much money. So we're talking about pips of value, and that's standardized to 10. It's the only way I know how to count it. So anyway, margin is a whole nother thing, and I recommend going with a larger, more established, and more liquid broker when you can, all right? And I can't just yet, but I will soon. I'm going to do it very soon. A small, unregulated broker, if we need to do that, this is what I'm going to recommend, okay? As soon as you can double that account and maybe bring it up a little bit more, like a double and a half, pull out your original investment as fast as you can. Every month that goes by, you should be pulling out about 20%, maybe a little bit more, but I would not go above 50, okay? You just want to go somewhere between 20 and 50% of all your trading gains in a month. So if you have an account that has a decent amount in it, and you're firing 0.10s all day long, you're making $250 one day and $350 the next, and $100 on a slow Monday, and the whole week goes by and you make $1,000. The whole month goes by, you make $4,000. You're probably going to want to pull $1,000 out. You need to get paid, all right? And you don't want your broker to go bust with your money in there. So that's why I'm talking about getting your original investment out as fast as you can do it, and then getting used to taking 20 to 50% of your money out every single month at the end of the month. But leave some money in there for account growth, because we're looking to continually get bigger bullets, and that's very important. All right? Okay. So if your account is a US based account and you're only going to get 50 to 1 margin, that's just the worst thing in the world. Okay, I hate that. I don't want that at all. I would prefer the 200 to 1, like you see what I have now with this broker. 400 to 1 is pretty good. 500 to 1 I am okay with, but I would never use this margin. Margin kills, and if you have 500 to 1 margin and you load the boat, you are gambling and you're putting so much at risk. You could be absolutely crushed if you got on the wrong side. So if you've got a 5,000 account, you trade 2.5 standards of Australia or Canada, you're 100% margin. The slightest move it makes, you're losing money. I mean, by the time you click the buy button, you're instantly down 4 or 5 pips on a US account. You'd immediately be down that much. And if the move starts to swing 10 or 15 pips against you, you're really down. You can't do 2.5 standards on a $5,000 account, okay? You could hold 0.5, all right, or 50,000 units of currency, but you'd be 20% leveraged, and that's rather large. And I don't think that should be done unless you are a very, very good trader and that you have stops in place and that you are continually on top of your trade. I mean, finger on the trigger, ready to kill it first chance you get, for a profit or a loss, whatever. I mean, you don't want to trade like that to get away from you. Okay, I mean, right now I just looked at my account before we started, and I think I have something like 15 micros in place. So I'm leveraged 1 to 15. It's nothing. Okay, money management. So if you are sold to the 2% rule, just think about that, okay? And you're only willing to risk 2% of your account, then for every $100, you can risk $2. For every 100, it's $2. For every 1,000, it's 20. So if you have a $5,000 account, you're not going to wish to risk anything more than $100. All right? So if you've determined that this is your maximum risk and you're trading a full lot, you cannot even handle a 10 pip move. Do you get it? 10 pips wipes you out of $100. So it's very obvious that this size is too big, and you have to reduce your size traded accordingly. If you were lucky enough to find a very drop-dead sexy 1 hour buy signal, okay, and you could look at that 1 hour buy and you could see the risk was 24 pips. I'll just pick a target, okay, 24 pips. You have to adjust your trade size accordingly to be able to handle the 2% loss so that you don't have it dive down 24 pips and nail you. All right. And this is something that you really want to do all the time. And that's why I like the standardized size. And for me, it's just a lot easier to standardize everything and say 1 bullet. 1 bullet. And sometimes I'll do 2, and sometimes I'll do 3 when I need to. And you heard me today. We're getting a little bit hot on one of these trades we've got going on. I think today I fired 7 bullets. Now, I've only got 3 left in the clip, folks. Okay? It's like the gunslinger out at the gunfight. And, he shot 7 bullets off, and not everybody's dead. Okay? And he knows he's only got 3 bullets left, but there's 10 more guys to kill. So you know what I'm saying. That should come across very well. I have got to be very, very careful with the firing of those last 3 bullets, or I'll start to push right out of my comfort zone. Okay? So money management is important. You have to think about it for yourself. Work out a plan where you're comfortable and you're not going to go crazy. All right. Well, I guess I already spoke that before I even clicked the button, so I guess there's no reason to go over it again. All right, you see a trade, 15-minute, 1 hour buy, right? You can risk 20 pips. You know what you're doing. 2.5 R value, risk reward. You have to calculate this well. All right, you could do a trade like that with 5 mini lots. Set the stop, set the target. Think about it. If you're right 70% of the time, and you place hundreds and hundreds of trades like this, you are crazy profitable. being a loser 30% of the time. Okay? Now, some people don't like that word, loser, but the truth is, as a trader, we would be out of our minds to expect 100% profitability at all times. That is insane. There is no such thing. I am forever a Forex loser. Forever do I lose money. Okay? As long as I make it 70% of the time, and I'm getting something like that, and I got 30 losses over here, look at what it comes out to. Are you willing to lose 600 pips to make 3,500 and end with a net 2,900 pips? Yes or no? Obviously we would. Okay? So it all comes down to R value. You want to try and find a trade that is preferably greater than 1 to 1. All right, it should, the lowest it should be is 1.5 to 1 or 2.0 to 1 or higher. Like the other day, if you remember in the trade room, we had looked at a trade. I can't remember what it was, but we basically determined it was a 1 to 6 risk reward. I would take trades like that all day long, all day, and I don't care if I lose 30% of those. It's not going to bother me one bit. So it's simple math. Choose the percentage of risk that is acceptable to you. Figure out your max dollar amount you're willing to lose. Great traders count how much they can lose first. Please remember that. I didn't make that up. You know where I got that from? It was from Market Wizards somewhere. I can't remember which one. Market Wizards 1 or 2, where Jack Schwager had interviewed a whole bunch of really great traders. I don't even know who said this, but I loved it. I loved it. Great traders count how much they can lose first before they put the trade on, and then they put the trade on accordingly to what they're willing to risk. All right, just makes good sense. Now, pardon me. So let's talk about swing trades. Now, if you see a swing trade, right, with 150 pip gain potential to a 50 pip loss potential, then your size, you've got to cut it way down so that you're not willing to lose more than your 2% or whatever you've determined. Now, some of you might determine I'll go 3. And some of you might have determined, you know, every once in a while I'm willing to go 5. If it's a really great signal, maybe I'll do a 5% risk, right? So you have to set that up with your trading plan. It's not for me to dictate that to you guys, okay? You determine your max and then you work backwards from that. So if all you had was a $2,000 account and your risk was 2%, that's $40. And if you felt okay stretching it out to 50 just because the trade looked really, really good, then that is a 0.10 trade lot that you could put on. You could trade 0.1 with a $50 risk and 150 reward. And if you can do that trade hundreds and hundreds of times, be correct 70% and lose the other 30% of the time, you are insanely profitable. I mean, that is a trader's dream. That's where you want to be, okay? If you're not willing to stretch it to the $50, you say, oh no, then you'd have to chop it down to 0.08, okay? Just lower it down a little bit. It's simple math. It's very easy. So now we can talk here about reward value and risk and consistency. So basically R value is simply reward versus risk, and it's best whenever possible to have a minimum of at least 1.5 to 1. 2 is better, 3 is better, anything higher than that is fantastic. Okay, every time you lose 20 pips, it's fine because you're going to make 40, 60, 80 on other trades. It's just basic math, right? Consistency is how often you're right. Consistency is basically it's possible to make money throwing darts at a board. Okay, yes, it's possible to roll some dice. All right, we could even have a monkey, you know, point trades out for us with his finger. You know, talk to a chimpanzee and say, point it out to me. What should I buy today? What should I sell today? But still, I mean, you can do that if you have the proper money management in place. All right, because 50% of your trades are going to be right over time, 50% are going to be losses. If every trade loses 20, or gains 40, you're still profitable. So the whole thing about consistency is honing our skills through price action and through knowledge of the market maker's business model. Sneaky, dirty, rotten market maker tactics that they're going to pull on us. When you know the market maker's tactics and you're prepared for it and you're watching for it and you see them pull these dirty, rotten tricks time and time again for the last 4 years, pretty soon you're just laughing at it because you know it's coming. You know what you're looking for. You know the candle you're looking for, the volume, whatever it is, and you are going to get your consistency up big time. 70 or 80%. That's where we want to get to. Now, my FX book, I had linked it up to my other account like quite a while ago, and it broke. It just wasn't working right. But at the last time that it was working, it said that this year I had achieved an 84 to 87% consistency level. I was very happy with that, okay? If we can get to that level, we're doing really good, guys, all right? So losses are with us forever, but as long as we keep them very small, right? And the gains are bigger and the losses are like less frequent, it's the key to our success. And that's the issue. Now, I think I'm done with this video. I really want to hop over to the next one because I just burnt a half hour up. So I'll go ahead and kill this. We'll get to the next video. Before I kill it, guys, is there any question at all on any of this stuff? This is just one part of our night tonight, okay? I don't want to spend too much time here, but does anybody have any question about R value, consistency, pips, money management, anything at all? Type it in the box now. It's all clear to you. Very good. Excellent. I know, like I said, this is a little bit beginnery-ish, you know, beginner stuff. Okay. Great. I'm going to trust everybody's there, and we are done. See you on the next video.